Good evening and welcome to this month's Self-Managed Super Fund Club mentoring webinar. Before we start, just want to cover off the important information, which is the presentation that's been produced by the SMSF Club. We're lucky enough to be joined by Pete Muellers, who is a director of UBS. UBS is a global investment bank. So I want to go through the introduction tonight, go through a bit of important information, then I'll pass over to Peter to talk about everything you need to know about instalment warrants. But before we get into that, we'll probably go through a few case studies with Peter, a few examples, likewise some opportunities that may present themselves in the marketplace in the lead up to the end of financial year. That past performance is not necessarily indicative of future performance. There's no guarantees or anything like that. Tonight is an opportunity not just to talk about the benefits of warrants, but also to go through in detail about the risks associated with warrants above and beyond that of normal listed instruments like shares. Tonight, like everything the SMSF Club does, we're a big believer in education. We believe that there's a gap in the financial planning market to provide what's called general advice to our clients. That is, tonight we haven't obviously considered your personal investment circumstances when we've put together this presentation. But if you would like personal advice, speak to your advisor and we can look at developing what's called a statement of advice after we do consider your individual circumstances to determine whether or not any of the strategies spoken about tonight or in previous webinars is appropriate to your circumstances. There we go. I think you should all be able to see my screen now, I hope. Sorry about that. Firstly, let's go through what is a warrant. Now, warrants were created back in the 90s. Actually, I think the very first installment warrant or a warrant structure, which I think was called a installment receipt at the time, was developed back in 1991 when the government first issued shares in Commonwealth Bank of Australia. It was later followed in 1997 by Telstra. I think for CBA and Telstra there was probably 3 different instalments coming out where the government issued further shares in the companies to raise further capital off private investors. Now in 1991 the government at the time wanted to raise capital, so rather than just issuing normal shares in CBA, what they did, they basically meant that you could lay-buy shares in the company and that you would pay a certain amount up front and then you've got an obligation to pay a second installment. So these installment warrants were the first way superannuation entities were able to enter into a growth asset by incorporating some form of gearing. That is, you're buying a $4 stock, but you pay $2 up front and you've got a commitment to pay $2 in the future. So essentially you're borrowing that second dollar or second $2 for a period of time. So we go through the details of a warrant. It's a structured financial instrument. They're traded on the Australian Stock Exchange in the normal T+2 settlement terms. So it makes it really easy for you if you want to go about gaining access to a leveraged instrument, in that most of our clients have a normal share trading account. You can speak to your broker, send us an email and say, hey, I'm looking at some installment warrants over the banks, and we can trade on your behalf just as we can normal shares in ordinary companies. There's over 2,000 installment warrants quoted on the Australian Stock Exchange covering 100 different underlying assets. Now those underlying assets can be domestic shares like CBA or Telstra. It can also be international shares, a basket of shares, even exposure to a particular index like the ASX 200 as an example. You can also use installment warrants to gain exposure to currencies and commodities. The main features as to why people look at investing in warrants as opposed to just ordinary shares or ordinary baskets of shares is to first and foremost gain leverage, in that it's a way you can borrow to invest. Now when you're borrowing to invest, when you're right and the underlying asset increases in value, your returns are magnified, which is great. But conversely, when the share price falls or the price of the underlying asset falls that your warrant is, that's also going to magnify losses. So it's very important to understand that warrant, like all leveraged instruments, don't just accelerate returns on the upside, but also can expose you to greater risks. Warrants can also be a great way, and Peter's going to talk a bit more about this in detail, to generate an income stream in the form of dividends and franking credits. Then finally, generally because installment warrants are what's referred to was actually the very first limited recourse borrowing arrangement. It enables you to protect the value of your share portfolio. So that's a basic introduction of what warrants are. But rather than hearing from me, I'm not the expert in warrants. Lucky enough, we do have one of the leading experts in warrants in Australia that's joined us, Pete Mamulis. Thank you and welcome, Peter.
Thank you, Justin.
Peter's been involved in investment banking for the last 15 years, working at a fair few of the largest investment banks in Australia, and I've had the lucky enough to work as a client of his for a large portion of those 15 years. I think his entire passion is not just with his family, but working in investment markets. You look at the hours that he dedicates to investment markets, I don't know how he has time for his family. So what I'll do, Pete, is pass over to you to go through your slides to talk about warrants and I suppose the evolution of warrants from the CBA days back in 1991 to where we are today and talk about UBS installment builders. Thank you, Peter.
Sure, no worries at all. And thank you everyone for joining. I appreciate the fact that people, passionate about their investments inside their superannuation funds and are willing to devote some time to continuing education in this space. Justin, if we could flick over to the next slide just to get the ball rolling. Essentially, installment warrants were created. Justin rightly said that the CBA, or the Commonwealth Bank of Australia float, was the first time that the government allowed the use of installment receipt technology or the framework to allow people to make a two-part payment to buy a share. And you've seen, the biggest profile installment receipt issues were the Commonwealth Bank, which the first issue we saw in 1991, and then Telstra, where we saw Telstra 1, 2 and 3 starting in 1997. And that same framework, or a very similar framework, is used to list what we call the investment builders, which were essentially created to provide investors with the ability to gear or to borrow to invest with a degree of control around the investments that they're making. So you can buy a wide variety of shares. There are about 40 or so individual shares that you can buy in this format with flexibility because of the listed nature of the installment warrants or the investment builders. It gives you the ability to buy and sell them as you choose. Right? They are listed instruments that trade on the ASX on a daily basis. So during market hours, you can buy, you can sell, you can buy more, you can sell some depending on the way that you see the market moving. So certainly giving you that flexibility. The important information, and this information is a publicly available brochure, again reiterating the comments that that Justin made earlier, that we are providing you with general advice. This is simply product information on the product. If we can keep clicking through, please, Justin. On this slide, this is a great place to start. What are we really trying to do as investors inside our superannuation accounts, and particularly in self-managed super? We may be trying to build wealth, which you definitely are trying to do. Essentially in the accumulation phase, we're trying to build it with a variety of assets. Specifically today, we'll be talking about equities or Australian listed equities on the ASX. We may be trying to diversify away from a particular asset class or a sector. And typically, in the current day and age, we are finding people with lots of investments inside property, but maybe looking for a more liquid exposure to financial markets or to an asset class like shares. Now, I call that building wealth, right? But typically investors or trustees of self-managed super funds may be looking and may define that themselves as they're trying to create an income stream, or they're trying to build income and a dividend flow in retirement. And certainly these instruments can be used to do that. In essence, the term investment builders defines two similar types of gearing. One of the types is called a dividend builder, and the dividend builder is designed to send cash or the dividends from the underlying shares to the investor. And the share builder is essentially used to build wealth inside the installment warrant. So the dividend flow is used to reduce the loan amount in that underlying installment warrant. And I will go through those examples. Remembering though that both of these types, both share builders and dividend builders, which we will go into, can be bought and sold on the ASX. Amount that you want to invest, and so the amount that you borrow, it allows you to invest as a variety of different legal entities, whether that be an individual, self-managed super fund, company, etc. There are no credit checks. So while we are talking about borrowing to invest, because we are buying in a limited recourse way, there is no further recourse to the investor. UBS, as the issuer of the warrants, has recourse to the shares underlying the installment warrant, but we don't have recourse to the investor. And because of that, there are no margin calls. There will be no demands made on you for any other money, regardless of the circumstance that may occur during that time. And because they're listed on the ASX, you get the observable pricing that is available during market hours. You receive analysis on our website on a daily basis, and you also have access to tax statements that we send out to you in September, October of every year. And that simply says this is the amount of interest that the investor is due to have paid, this is the dividend flow, this is the franking credits that may be attributable to that share position. If we could move to the next slide. So what in essence we are doing is building a share, or building a portfolio, where instead of putting in 100% of our own money, we are actually borrowing some money to buy a share in a two-part way, or by gearing to invest. Essentially, your dollar may buy you a single share, but if you could use your dollar and borrow another dollar from UBS, you could gain further exposure to the marketplace than you otherwise would. And we'll talk through the format around how you can do that in a relatively straightforward way. There are the two types. The share builders are designed to build a share portfolio. The dividend builders are designed to build a dividend income stream from those shares. They are the pricing and the lending in the installment warrants that we offer are quite competitive, and we'll go into a pricing sheet at the end of this presentation to show you how we put them together. But effectively, you are paying interest, and the interest that you're paying on that loan consists of two components. One of the components is pure funding, what we call paying interest on a loan. And the other component that you pay, that we summarize as interest, is called a walkaway feature. And the walkaway feature enables you to be able to walk away from that loan at any point that you desire. It enables you that even if you buy a stock, let's call it for argument's sake, I buy Commonwealth Bank, trading at around about $80 at the moment, and the share price falls dramatically, there is no obligation on someone, even though you have a approximately $40 loan, to pay back that loan. If you do decide to pay back that loan, you can take possession of the underlying share. If we can flick to the next slide. So some of the key features: you're the beneficial owner of the underlying shares, franking credits, no matter which type of investment builder you pick, whether it's a dividend builder or a share builder, you get access to the franking credits. The purchase price that you pay, plus the loan amount that UBS lends, are used to pay for the underlying shares, and the interest up to the annual interest date, and I will go through that to explain. But once you've paid the purchase price, there is no requirement on you to contribute any more money to that position over time. You can buy more if you like. You can always sell what you've already bought on the marketplace, but there is no obligation on you to make those payments, which is what makes it superannuation friendly. The dividends, ordinary dividends from the underlying shares, can be used to, in the case of a share builder, be used to reduce the loan amount. In the case of a dividend builder, they are paid out to you in cash. Any interest on the loan will be added to the loan amount on an annual basis around June. And this year it was the 8th of June, where we simply add an amount which is equal to the interest, which consists of the walkaway feature plus the funding that I explained earlier, and adding that to the loan in June. The walkaway feature is the feature that we talked about that allows you to walk away from the loan at any time. Important to note here, and I have made mention of it, the maximum potential loss from you from buying an investment builder, whether it be a dividend builder or a share builder, is the upfront payment that you've made. So even though you have made a part payment, if that share falls to zero and you have a 50% loan, there is no requirement on you to pay that. Superannuation funds can invest, and this is one of the few and the most effective ways to get exposure to the equity markets in a single investment. Some of the risks: well, leverage certainly magnifies losses. You need to keep in mind, however, that it's losses to a point, because you don't have an obligation to pay back that loan. Share prices going up is great in this sort of format. Share prices going down, not so great in any case, whether you're buying a direct equity or an investment builder. There is no capital protection, as in you can lose the amount that you've paid up front. The amount that is protected by that walkaway feature is the loan amount, not the capital that you contribute. The interest rate may increase over time, and dare I say hasn't increased for quite some time, but that may be the case moving forward, and we need to prepare for that and keep that in mind when we're making investments like this. The dividend income may be less than you expect, and that risk is really around the view on companies and the view that a bank may decrease its dividend, or Telstra may decrease its dividend. Certainly BHP has decreased its dividend in the last few years, as have a number of other companies. But certainly there is some dividend risk if stocks don't pay the dividends that we all would expect. Tax laws may change, and early termination may occur in and around the annual interest date following certain events. And what we're talking about there is if a share price falls significantly in value, then it doesn't really make a whole lot of sense to continue in that position. But we can discuss that as we move on in the presentation. If we could have the next slide, please. At the start, you select with your advisor, broker, loved ones, etc., the underlying shares that you'd like to invest in. You select the loan amount that you'd like to borrow, and there are quite a variety of different loan amounts. We call them gearing levels available in the market. You consider your time frame, the best investment builder to suit your requirements, whether that be a dividend builder or a share builder, and you run from there. During the investment, you would receive the ordinary dividends in the case of dividend builders, or you'd have the dividends reduce the loan amount in the case of share builders. The interest for each interest period is charged in the annual interest rate once a year and added to the loan. Interest deductions should be available, as well as franking credits if you're eligible. And what we mean by if you're eligible is it's not something that we can opine on, but certainly seeing a tax advisor on that and taking a reasonable view on that. You can choose to repay the loan at any time, and if you do that, you become the owner of that underlying share. You are the owner, the beneficial owner anyway, but if you pay back the loan, the fully paid ordinary share comes to you, so you can do that at any time as well. And you can choose to roll from one instalment warrant to another. If you'd like to hold to maturity, you can either repay the loan, you could let the position expire, and by that I mean the do nothing option, which is UBS would allow the position to expire and pay any excess value back to you in the form of cash. And that's how that would work. Investment builders right for you? Look, this is an individual scenario for each and every investor. If people are looking for geared exposure, if someone would like to diversify a portfolio away from a certain asset class, or they would like to make an investment in something other than unlisted property, for example, this may provide a good scenario. But certainly people who are after the convenience of no application form, credit checks, and the usual scenarios that come with borrowing to invest. And anecdotally, we've had a number of conversations with investors who are finding it increasingly difficult to borrow from their banks for the purpose of superannuation lending for property. The walkaway feature gives you an element of safety, that you've got no further obligations to pay should you choose not to. If you like the benefit of dividends, franking credits, and growth, then certainly the investment builders may be an appropriate investment for you. If we can move to the next slide, please. This is the profile of a loan. There are a couple of different charts on how these things work. This is showing you what happens to a loan amount over time. And you'll see that we might start a loan amount at a given level, let's call it 50%, and you'll see 2 steps down in that loan amount in the case of a share builder. Those steps down are when we have ex-dividend dates, interim and a full year dividend paid on the underlying share, and we use that dividend to reduce the loan amount. And then once a year on the annual interest date, we will increase that loan. And then further down, we have another ex-dividend date. Next chart on the next slide will show that in a longer time frame. So you see the top of that page, you'll have a share price increasing over time, and you'll have that 2 steps forward, 1 step back approach, where you have 2 dividends coming in, 1 lot of interest being paid, 2 dividends coming in on an annual basis, and 1 lot of interest being charged on the account. And you'll see that loan amount stepping down over time. So what you're in effect doing is increasing the equity position that you have. So there are 2 things working for you: an increasing share price, and you also have a decreasing loan amount. And that's typically a profile that you might have out of the ASX 200, the STW as the ETF, for example, out of a banking portfolio, out of Telstra, etc. So when you have a stock that is paying a dividend and increasing in value, that's what you'd expect to see, an accumulation vehicle that behaves similar to the top of that page. On the second part of that page, on the bottom half, you'll see a negative performance in a share. So assuming you've bought a share and doesn't pay a large enough dividend to reduce the loan amount, we're charging interest once a year, and over a few years you see that loan amount increasing slightly, and you also see the share price falling. And at the end of that chart, you might look and say, well, I've got a share price that is trading below my loan amount. So at that point, what do I owe the bank? You can't have a loan that is higher than the asset that you're holding. In this particular case, the investor would be able to walk away from that loan and not have any obligations to pay that loan back, even though that position is underwater. It's like having an asset that may have been worth 100 is now worth 50, but the loan on that asset might be 60, and you're not having to pay back that loan ever. You can simply walk away from that position, and this is why you pay for that walk-away feature as part of the first payment that you make when you're buying the investment builders. If we can go to the next slide, please. In this case, we see the dividend builder, and the dividend builder scenario is similar in profile. We're adding interest once a year, but on the ex-dividend dates, the dividends are not used to reduce the loan amount. The dividends are paid out to investors in cash, and you can create an income stream from a share, and the next two slides will show you how that happens. And again, you'll see a positive performance and a negative performance, just showing you the risks of each and the benefits. So slide number one, the positive performance, you'll see a share price increasing in value and the loan amount increasing once a year when we're adding the annual interest. In that top scenario though, an investor may have invested $1 or $100,000, whatever the case may be, but they have access to twice the number of dividends and franking. And that occurs because for every dollar that I've invested, I've also borrowed a dollar from UBS, and I've got access to, generally speaking, about twice the number of shares that my dollar can afford. So apart from the interest payment that I'm making, the amount of dividends and franking that are coming through to me in a superannuation environment can make the strategy quite powerful. And the negative performance, again, your decision making, you bought a share that didn't work very well for you, and the share price has fallen over time, the loan amount has increased over time, and you're in a position where the share price is lower than the loan. The question again is, do you have an obligation to pay back that loan at that point in time? And while you can, if you want to, there is no obligation on you to do so. The other point that I'll make at this juncture is say that along the way, because this is a listed instrument, if you see a share price moving against you and you do not wish to hold that position any longer, you can simply sell it on the ASX. And by selling it, you can use the funds that are raised from that sale to buy another share. And we can go into that in more detail later on. If we can go to the next slide, please. In a case study, this particular strategy is a strategy that can be used, but this particular strategy can't be used inside a self-managed super fund scenario. So I'll just make that clear up front. For example, if I'm holding some Commonwealth Bank shares, and again, my go-to stock, Commonwealth Bank, and I've been holding them for a very long time. I may have bought them on the float, I may have bought them at a significantly lower price than the current price today. And I don't necessarily want to sell those shares, but what I would like to do is extract some money from them to make other investments. So what I can do in that situation is not sell my shares, lodge my Commonwealth Bank shares inside to UBS. UBS would then convert my shares into Commonwealth Bank installment warrants. They would give me approximately 50% of my money back. So in this case, probably about $40 a share. And I could then use that $40 to go off and make another investment. I have not sold my CBA shares. All I have done is borrow against them. Now that strategy is available for companies and individuals, not available for self-managed super funds. If self-managed super funds are wanting to engage in that strategy and you already have shares in your super fund, what the SIS Act says that you have to do is sell those shares and then you can use the funds to buy the warrant. And that's simply, they view that as putting a charge on existing assets. It can be done, but you do need to trigger a capital gains tax event inside the super fund. But keeping in mind that a CGT event in a super fund, if you've held the asset for longer than 12 months, is 10%, which may not be as much of an impediment as one might originally think. If we can keep moving forward, please. In a case study as a supplement for your investment strategy. So you may want to create wealth, and a way to create wealth is to apply increased exposure to the marketplace, in other words, to gear into the marketplace over a medium to long period of time. Gearing strategies work best when we have a number of years to allow them to work, and simply being able to use the available funds that you have. And let's say, for argument's sake, you've got $100,000 or $200,000 in a superannuation fund, and you would like to be able to buy as many shares as you can to diversify a portfolio. Instead of your $100,000 odd being used to buy 4 shares, your $100,000 could be used to allow you to borrow a further $100,000, turning it into $200,000 and be able to buy 8 shares or more, or less, depending on your circumstances. But what it does allow you to do is to gain a larger access to the markets that you're wanting to invest in, and doing it in a way that isn't laden with credit checking for loans, making sure that you've essentially gone through the AML and credit checking. Once you have a stockbroking account open with a broker, advisor, etc., you can essentially buy installment warrants on the market. The only thing you need to keep in mind is that you're holding what is known as a warrants agreement form, or a WAF for short. Most stockbrokers will know what you're talking about as soon as you request the WAF, or a warrant agreement form, but you need to have that in place before you're able to buy these instruments and get exposure to warrants in this way. If we could move to the next slide, please. So some of the key risks, certainly borrowing to invest can magnify or accelerate losses. I think that is probably the most important of risks. If you believe that the markets are trending down, well, you wouldn't be buying shares anyway. But if you believe that the market's going down, well, investment builders may not be appropriate for you. If you believe that, and actually at this point I might raise an example of an investor who was speaking to me about these investment builders, and the example that was raised was, if you think about one of the stock that has hurt you the most, and for me, I remember a stock called Babcock and Brown that didn't do too well in my portfolio. Now, let's say I had $100 to invest and I'd bought Babcock and Brown using my own funds. I would have lost that 100 if I hadn't sold Babcock and Brown on its way down. But if I had borrowed $50 and put $50 of my own in this format, in an investment builder format, and Babcock and Brown went to zero, well, I wouldn't have lost, while I had exposure to $100, I wouldn't have lost 50, because I had no further obligation to pay back that $50 loan. So while losses can be magnified, it is to a point, because there is no obligation to pay back that loan. Now, some of the other risks here, we certainly have talked about interest rate risk, the risk of interest rates going up. Dividend risk is the risk of stocks not paying the dividends that we expect from them. Certainly legislative changes that may occur over time, and anyone involved in the marketplace would have seen a few tax changes in their time. Early termination is when one of those shares that you have bought, if you haven't sold it and it falls below the loan amount, that could terminate, but at that point it would make no sense for you to hold that position any longer. So certainly please understand those risks, please read the documents, and please ask the questions that you need to ask of either myself or the advisors that are advising you. If you could move to the next slide, please. This is typically the way that you see investment builders listed on the marketplace. And the first example is CBA SS something. Now, when you see SS, the fourth letter, so CBA is obviously the Commonwealth Bank. The fourth letter S means that it's a share builder, so something that is designed to accumulate, or where the dividends are used to reduce the loan amount. S, the fifth letter rather, is an S, which means that UBS is issuing this investment builder, and the last letter in the six-letter code is the series, and it might be A, B, C, or D, and the pricing that we'll go through today is on Series E. On the other side of that page, you'll see BHP, ISI, and BHP is simply an income builder or a dividend builder, and you'll see the fourth I there for income. And again, S means that UBS is the issuer and the series that you may have. We can flick on. Contact details for us, and then apologies for the small font in the pages here, but the pricing sheets are published every day. And if you can see the third to last column there, it has funding cost component. And you'll see that with the interest that we charge on funding is 4.2%, which these days is very close to the home lending rate for many investors. In fact, dare I say, it might be cheaper than many investors pay to borrow to invest in property. You'll see the next.
For property, Peter, the self-managed super fund loans for direct property is closer to 6%. So well, it'll be at least 1.5% above that rate. While I'm talking about property, there's a question that's come up. A lot of people have set up self-managed super funds to buy direct property and to enter into a borrowing arrangement. With interest rates going up, loan-to-value ratios declining, credit checks, all those sort of normal traditional lending obligations, banks asking for personal guarantees for any loans written in SMSF. Is there another way that investors can gain exposure to property and leverage using some of the UBS warrants?
Yeah, there sure is. It is simply being able to use the listed REITs, or the real estate investment trust that exists as listed vehicles in Australia, and being able to buy them in the formats that we've just described. So in a typical scenario, you might have an investor who's bought a property or two, may be quite heavily invested in that sector, and would like a liquid property investment which is geared. And Justin, I didn't know that the rates had reached that level for self-managed super funds. I certainly knew that they were in the 5s, but not the 6s, and that is typical of what's happening in the Aussie mortgage market, and certainly in lending for investors. But in this scenario, you can buy SGP, SSE, you can buy VCI, SSE, you can buy a number of different property exposures
So just
in the marketplace.
Mortals, what does SGP stand for?
Yep, so SGP is a code for Stockland Group. Stockland are a listed REIT. They build properties, they have some residential exposure, but this is one way of gaining exposure to a stock that is exposed to the market, that is exposed to the property market, and you can buy it in a single investment. There are others. Justin, you asked the question specifically on property, but typically investors might want to buy exposure to infrastructure stocks. If that is the intention, then certainly buying some of the listed infrastructure plays, Sydney airports or Transurban, up the page a little bit is two others. There's Lend Lease up there, LLC, and GPT, General Property Trust. You'll also see DXS, which is Dexus, and the stocks that we've just mentioned are property REITs. They are listed instruments in the marketplace which will give you exposure to that sector of the market, and that might be to property in terms of office property, it might be development, it might be industrial property, it might be retail. So you can actually take a broader view on property than simply buying an investment property in the local suburb. So certainly diversifying in this way will diversify into the property sector without the need to go through the credit checking, giving you an element of safety in that it is a limited recourse loan where you don't have to pay back that loan if anything happens to the underlying investment, but specifically the difference is that it is liquid and liquid daily.
So with that, like a lot of investors are buying one residential property in their super fund and borrowing to fund the purchase. That would be deemed key risk because a large portion of your super fund is invested just in one asset. As an example, if you lost a tenant, you can't get a tenant for a few months, that's going to put a lot of cash flow pressure on your self-managed super fund. Where you look at the Westfields, the Stocklands, the Lendlease, they're billions of dollars worth of property and diversified across all different stages in different geographical areas of the property market. So you can still get borrowed funds, you can still gain access to the property market. It's just in a lot less risk environment by being so diversified across those underlyings.
Look, the other scenario there is, Justin, once you've a single investment property and you're wanting to have access to a small amount of cash, it might be $50,000, well, you really can't sell a bedroom on that house or half a bedroom. This format, in a listed format, if you've made a position, if you've got a position of $100,000 or $200,000 and you're wanting to gain access to $50,000 of your own funds, you can simply sell that investment builder on the market on any given trading day and liquefy your investment if that's what you're after. The other thing that sometimes people forget when they're wanting to take exposures in the property market is the effect of stamp duties, particularly in some states, where the cost of the stamp duty is significant enough for you to reconsider it, whereas in listed equities, and in this case here, the listed REITs, there is no stamp duty on share purchases any longer. That was taken out of the marketplace in the early 2000s.
Yeah, look, agreed. In addition to that, like when you do buy a residential property, like just to buy one costs $500,000 plus, and $500,000 in Sydney will get you half a car spot. It's a good point where if some of our investors may already have exposure to property and love property and want to get exposed to more property, if you've got a small amount left over by using the listed property trust and UBS installments as a way to gain exposure to it, you can do it with a lot less and also diversify into other asset classes in addition to just increasing your exposure to the property market.
Yep. Justin, and on that point, I guess that if I've sort of come across here as someone who's not enjoying property, please let me make my matters known that I actually enjoy investing in direct property. My view here is that people should be diversified or diversified into different asset classes, into different sectors, and maybe when is looking like it's getting toppy, it might be an invitation to take another look at diversifying and diversifying away from just the unlisted property sector and diversifying into more liquid assets anyway. So it's simply an invitation to consider those things rather than saying that this is a one-way street where one might be saying don't buy a property. We're not saying that. It is simply around making prudent decisions to make sure that your superannuation fund, and as trustees, you're responsible for that, your superannuation fund can afford to make the payments that it needs to make over time or look after its trustees in the way that it was designed.
Pete, we might go to our questions. There's a few questions that have piled up as we've spoken through the presentation. But firstly, thank you for a very informed presentation and analysis of not just warrants, but also the different ways you can gain exposure to different asset classes. So thank you for that, Peter. One question that we've got from Ian in Queensland is that you talked about the liquidity. Like when you're buying or selling a installment that's not buying shares in the underlying company, who creates that liquidity? Like if I wanted to sell out today and get paid in a few days' time, how am I guaranteed that there's a buyer?
Yep, there are obligations on us as an issuer to have bids and offers in the screen. If we have sold an investment builder to someone in the marketplace, we have an obligation to be there to buy it back at a price that we publish on our website. Under the listing rules, we publish where the warrant price will be, both the bids and the offers on the underlying shares. So another way to look at this is so long as there is liquidity in the underlying stock, there will be liquidity in the warrant. So if, for example, AGL is trading with a 1 cent spread between the buyers and the sellers in the marketplace, we'll have the same 1 cent spread on our AGL SSE warrant. That is our obligation in the marketplace, and that's the way that we list these warrants. So certainly, to answer your question specifically, both other buyers and sellers can be there in the screen, but we have to be there to make that market.
And that's one of your obligations as a warrant issuer issued by the ASX, right?
That is correct.
Credit checks. Why don't you need to do credit checks?
Look, a good question. It's simply because you have paid all of your obligations up front. Remembering that you've paid an amount of interest up front for a year long between now and the next annual interest date, and you've paid for that walk-away feature cost. And if you're able to see the AGL top line, you'll see that the funding cost is 4.2%, the walk-away feature is 1.25%, giving me a total interest rate of 5.45, which is a combination of the funding interest and the walk-away feature cost. Now, once you have made that payment, that loan that you have purchased as part of this instalment warrant is essentially limited recourse. So you have no further obligations to pay back that loan, that walkaway feature. Now, we're capitalising interest once a year. When we capitalise interest, we also increase the amount that we are protecting on that loan. So as that loan increases in value, in the case of dividend builder and in some cases the share builder, we increase the protection on that loan. So if the market was to fall, you would not have an obligation, and that's why there's no credit check required, because I don't need more payments. I don't need you to fund any more interest. The structure capitalises the interest once a year. In the case of share builders, it reduces it twice a year with the dividends, and in the case of a dividend builder, it pays out the dividends in cash. In both cases, you get the franking credits, but the reason that we don't need the credit checking is because all of your obligations are paid up front.
Excellent. Thank you, Peter. I think that's the majority of the questions that are covered. In summary, just my final comment is to focus on one of the key points Peter mentioned, and that was with all investments, they do take time. You should be taking a long-term view on all underlying assets. Choose asset classes that have traditionally performed very, very well over the long term. That's why I'm a big believer in shares. I'm a big believer in property, whether it's through a real estate investment trust that we're talking about a few of the times tonight, or in direct property. You buy a great asset and you hold it for the long term. That's why I think shares, property, even considering installment warrants for the right investor, is a good matchup for a self-managed super fund. Those people in accumulation phase that have time on their hands to enjoy the benefits of the long-term leverage features that installment warrants offer. Any final comments, Peter?
Yeah, look, I think the comment that I need to make clear is that superannuation environment is an environment that is taxed at a particular rate. For accumulators, it's 15% tax rate for contributions and also for earnings inside the fund. When you're buying an investment or an installment warrant investment builder in this case, where typically you might find that dividends are paid and the franking rate on them is 100%, meaning that the franking credit attached to the dividend is 30%. Right? If I've got a 15% tax environment and I'm earning 30% in franking, and for every dollar that I invest, I'm borrowing another dollar, I'm essentially getting twice the number of dividends and twice the amount of franking, which means that in a 15% tax environment, I can reduce substantially the amount of contributions tax and earnings taxes that I'm paying inside my superannuation fund. Doing that for a number of years can do some wonderful things in terms of compounding, reducing the taxes in the fund in quite an effective way, in a way that is essentially using listed instruments, can be quite powerful. Now, it becomes further enhanced if you're in a zero tax environment in the pension phase, but certainly consider your own circumstances, talk to advisors, but certainly look at some of those benefits that may not immediately become apparent during some of these presentations, but certainly an invitation to ask another question of people that may be able to help you.
Well, thank you very much, Peter. We really appreciate you taking time out of your busy schedule to help our clients be a bit more informed in making their trustee decisions and managing their self-managed super fund. As Peter mentioned, the next step, while we've got share trading accounts all set up for the majority of our clients, we do need a warrant agreement form signed, and we can also email you understanding warrants booklet issued by the Australian Stock Exchange. So a mandatory discussion in addition to today's webinar about the ins and outs of warrants. That brings us to the conclusion of the webinar tonight. Look, why we spend so much time running webinars, getting keynote speakers like Peter from UBS, guys from iShares, guys from external companies like On Market Book Build, even internally, Michael Roberts is legal counsel, Gavin Conyers for tax and compliance, AIA for insurance. Why we bring keynote speakers in is to ensure that you receive the right information from the right people in a timely environment. So we're a big believer in investment, and knowledge pays the highest dividend, but only when that knowledge is applied. Next step is to become more informed. Send us an email with that information. We have gone through some complex topics tonight, and like all webinars, we upload it on the mentoring client library section of our website. So in a few days that'll be circulated to all clients and be available to watch at a later date from that website. So thank you very much for tuning in, and good night.
Good night.